Welcome to this explainer. Right now, absolutely everyone is fixated on the AI software revolution, but almost no one is talking about the millions of tons of physical metal required to actually run it. Today, we're diving into a massive, unseen collision between digital hype and physical reality. We're calling it the revenge of the real economy.
We tend to think of the digital world as weightless, right? Just floating up there in the cloud. But the cloud is incredibly heavy. It is built on concrete, glass, and most importantly, metal. So we have to ask the obvious question: who is looking at the raw materials required to actually turn AI on?
This is the core tension we're facing globally right now. On one side, you have the endless optimism of infinite software scalability. And on the other, hard, unforgiving physical constraints. You simply cannot code your way out of a physical commodity shortage.
To give you an idea of the sheer scale of the problem we're looking at, check out this number: 330,000 tons. That is JP Morgan's projected refined copper deficit for the year 2026. This isn't just a minor supply chain hiccup. This means global consumption is going to outright exceed our refined metal production by hundreds of thousands of tons. We are fundamentally running out of the primary material that powers our entire digital future.
That brings us to part 1, the AI copper crisis. Listen to this staggering warning from billionaire mining magnate Robert Friedland. He says the world must mine as much copper in the next 2 decades as it has extracted in the past 10,000 years. Just think about that. 10,000 years of human history condensed into the next 20 years just to keep the servers humming and hit our global energy targets. And we're trying to pull this off while existing mines are facing steadily falling ore grades, which means we literally have to dig up far more dirt just to get the exact same amount of metal.
And even before you factor AI into the mix, the global energy transition is acting as a massive baseline multiplier. A traditional internal combustion engine vehicle takes about 20 kilograms of copper. An electric vehicle, roughly 80 kilograms. That's a 4x multiplier right out of the gate. Add in the millions of miles of new transmission lines needed to modernize the electrical grid, and we've got a massive vacuum pulling on global supply.
Then you add AI. Data centers are projected to use 80% more energy by 2026. A single 1 gigawatt AI facility demands up to 50,000 tons of copper just for complex power distribution, grounding, and specialized liquid cooling systems. This is an entirely new source of demand hitting a supply chain where a major new copper mine takes anywhere from 15 to 20 years to go from discovery to actual production.
So where is this all heading? 42 million metric tons. That is S&P Global's forecast for global copper demand by the year 2040. That's a 50% jump from current levels. This number cements the reality of a deep, long-term deficit. The demand curve for copper is absolutely structural, and it is going nearly vertical. Let's pivot to part 2, the debt maturity wall. While the physical world is constrained, the financial world is facing a ticking clock. We are looking at a $2 to $3 trillion commercial real estate debt maturity wall hitting U.S. banks right now. It is a Godzilla-sized risk looming over the financial sector, and it's happening at the exact same time the world is frantically trying to finance the AI and green energy revolutions.
The cascading effects here are severe. With office vacancy rates still elevated from the permanency of remote work, property owners are suddenly being forced to refinance this expiring debt. But they have to do it amid much higher interest rates, jumping from the 3% range up into the 4% range, all alongside lower property valuations. The math for these buildings just literally breaks.
Now, you might be wondering, why does a commercial real estate crisis matter for a commodities explainer? Well, because liquidity strains forced investors out of paper promises and into hard collateral. Once systemic financial stress hits the banking sector, trust in digital or paper assets wavers. Capital desperately looks for an escape hatch, and that triggers a massive flight toward tangible, real-world assets that hold intrinsic value.
Which perfectly sets up part 3, the gold-to-oil anomalies.
To really understand this flight to safety, we look at the gold-to-oil ratio. Very simply, this shows how many barrels of oil 1 single ounce of gold can buy. It's essentially a thermometer for global economic trust, and right now, that thermometer is running incredibly hot. The ratio has hit extreme levels, reaching nearly 60.9 times, which is almost 4 times its historical average.
Think of it like a scale. Gold represents monetary fear. It's the ultimate defensive asset and safe haven. Oil, on the other hand, represents industrial demand, supply chains, and actual economic growth. Normally, if the economy is booming, oil goes up and gold cools off.
But look at the recent history. Spot gold surged past $5,500 an ounce. Investors are aggressively paying a massive premium for safety, driven by central bank buying and global inflation fears. Capital has just flooded into the ultimate hard asset.
And here is where it gets totally distorted. When the gold-to-oil ratio remains historically elevated like this, it means the market is valuing monetary safety far, far more than standard economic growth. Historically speaking, a gold price near $5,000 implies oil should actually be trading at well over $200 a barrel. The entire market is completely out of balance right now.
Let's look at how the smart money is reacting in Part 4, the hard asset rotation. Follow the timeline of institutional capital here. In Q1, capital aggressively sought physical gold for immediate safety. But by Q2, a massive realization hit. Physical gold is sitting at record highs, but the companies that actually mine these metals are being completely ignored. We're seeing an unbelievable valuation gap, where you can essentially buy gold in the ground via junior miners for a fraction of its spot price, around $50 an ounce. This sets up the potential for a 10x margin expansion for the actual developers.
And this exact same logic applies directly to base metals like copper, nickel, and zinc. Investors are rotating out of pure bullion and into the actual means of production. The developers located in safe, stable jurisdictions like the US, Canada, and Sweden. They are seeking secure, long-term supplies of transition metals that aren't subject to unpredictable geopolitical export controls. The smart money is buying up the fundamental materials required to build the future economy.
Which brings us to our final takeaway, Part 5, Position for the Supercycle.
If you have any doubts about the severity of these physical constraints, just look at the institutional consensus. JP Morgan and DBS Bank both predict copper deficits exceeding 310,000 tons. This structural shortage in the real economy is not just some fringe theory, it is a mathematical reality. We are simply consuming way more than we can pull out of the earth.
So the absolutely crucial point to remember is this. Today's volatility, the daily swings in commodity prices or those temporary market corrections, is just a cyclical pause. It is merely a surface wave on top of a massive structural bull market for hard assets. You cannot build a multi-trillion-dollar AI infrastructure or a totally revamped green energy grid on top of a broken physical supply chain. The underlying fundamentals demand higher prices to incentivize the massive mining investments we desperately need.
I want to leave you with one final question. In a world saturated by digital hype and teetering on a massive $3 trillion debt wall, how much of the real economy do you actually own? Because ultimately, when the dust settles, the only things that will matter are the things you can touch, mine, and burn. Thanks for joining me on this explainer. Keep questioning, and I'll see you next time.